I'm Rick Kaler. Thanks for joining me. How much money does it take to be wealthy? I've pointed out in previous columns and videos that this question is really unanswerable. It really depends on too many variables like social norms or personal circumstances, accounting methods, lifestyle, financial standards. And I think most significantly, it depends on whether you're talking about net worth or income. An annual wealth survey by Charles Schwab focuses on net worth. Our tax code focuses on income. And in this particular survey, they were asking what level of personal net worth would constitute being wealthy, and what level would result in financial happiness, and thirdly, what level would be considered financially comfortable. I thought this was interesting, and this year's respondents answered all three questions with significantly lower numbers than those from 2020. The difference, I suspect, is due to the impact of the pandemic. I think most people are feeling poorer this year. The average net worth considered as wealth was 1.9 million this year compared to 2.6 million in January of 2020. The average net worth for happiness was 1.1 million, which is down from last year's 1.75 million. And the amount for being financially comfortable was 624,000 this year, down almost a third from the 934,000 last year. Now, I suspect that next year we'll see these numbers rise, but it's just my hunch. I really wish the survey had asked participants their estimates of the annual income that would make people wealthy, happy, or comfortable. My hunch is that the answers would have been higher numbers than the income each of these net worth amounts could sustain. So in other words, I think people think if you're worth $2 million that the income that produces is way higher than what it really does. So let's look at that. Let's consider how much income each of the net worth averages would produce in today's dollars for the lifetime of someone retiring at age 66 with a high probability that they'll never run out of money. So how much can I withdraw annually from my 1 million, 2 million, whatever the figure, comfortably every year with a high probability that I'll never run out of money. So that amount from the wealthy net worth of 1.9 million is about 76,000 a year. The financially happy net worth of 1.1 million is an income of 44,000 a year. And the financially comfortable net worth of a little over 600,000 would produce 25,000 a year. So I'm guessing that some of you may be surprised at how low the sustainable income is for each of these amounts. And this is normal. Most folks overproject the income that a sum of money will sustainably generate. For example, it wouldn't be unusual for someone to assume an 8% return on a sum of money, which historically is what stocks have produced. So if you apply 8% to 1.9 million, you'd conclude an annual income of 152,000 would probably be reasonable, which is double the $76,000 that I suggest. What's the problem? Well, the problem with this conclusion is that the return will never sustainably be 8%. It'll be up 15% one year and a negative 15% another year, or anything in between. Rarely would you ever have a year at 8%. So the downside fluctuations could result in depleting the capital in down markets faster. The wild fluctuation of an all-stock portfolio, secondly, is something that few retirees can tolerate, or few anybody can tolerate. You can be up or down 50% on an outlier year like 2008. So the risk here is that a person is going to panic when a normal bear market is going to see a downturn of over 40% and sell out and never be able to recoup those losses. An additional problem with this is that by withdrawing all of the return, all 8% in this case from the portfolio, you leave nothing in to help it keep up with inflation. So the purchasing power is going to decline over a period of time. The importance of adjusting an income for inflation is a far bigger deal than most people realize. So let's look at that. Let's assume, and again, unrealistically, but for the sake of argument, that the 8% average return was a level, sustainable return. So that generates $152,000. But that's firm. That the principal never goes up, right? Which means $152,000 never changes. Which means that that amount is gradually going to buy less and less and less as the years go by. You know, go back 30 years ago and $100 bought far more than it does today, right? So even assuming inflation at the historically low rate of 2.5%, after 30 years, $152,000 is only going to buy half that, $72,500 of goods in today's dollars. So every year that goes by, you get a decrease in purchasing power, a decrease in standard of living. On the other hand, withdrawing that sustainable lifetime income that I suggested of $76,000 from the $1.9 million allows something to be left in the portfolio so that it will actually grow and keep pace with inflation. In 30 years, that $76,000 will have grown to $159,000 to continue to buy the same amount of money. So those two actually meet up. So, knowing your net worth can be one tool to assess whether you're on track in preparing for retirement. The more significant information, however, is a realistic estimate of whether that net worth can provide a comfortable and sustainable income. And I didn't even deal with, it depends a lot upon which area of the country you live in, because a dollar goes far further in standard of living in Rapid City, South Dakota than it does in Manhattan in New York. But that's for another time. Thanks for joining me.